Welcome to Investors Insights. Our topic today is debt, drugs, and driveways. That's right. You heard me, debt, drugs, and driveways. Stay with me throughout this vlog and the rest of our portfolio strategies team because all of this will make sense. But we think it's data that you need to know. So starting off, I've got distinguished colleagues here, and they are brilliant. I will say that on a recording. From the standpoint, Bobby Norman, Trey Booth, and Tom Miller. And I thoroughly enjoy working with them and having our portfolio strategies, research, and debate conversations. This morning was an eye-opener. And Bobby, you started us off talking about bonds. Now, bonds are debt instruments. They go to pay off debt. They also provide income. There's been a big debate with interest rates going up about bond values going down. And you addressed some things on bond strategies this morning. So talking about debt, drugs, and driveways, you would start to address the debt situation.
Yeah, last week I talked about how higher interest rates have been the leading cause of market volatility in recent weeks. But this week, I want to talk about an actual benefit of higher rates. And that is, for the first time in 4 years, real yields from bonds are once again providing investors with a rate of return that outpaces inflation. So we like to focus on real rates of return because it shows a bond's actual return by subtracting inflation from a bond's current yield. And as you can see in this chart, the blue line, which is the 10-year yield on Treasury notes, is above the orange line, which is year-over-year inflation. So on August 18th, that 10-year yield was 4.26%, seen in the blue line, which is above the 3.2% year-over-year inflation rate seen in the orange line. And that's from July's CPI report. That's a real yield of 1.1%. That's a welcome change for bond investors. So as today's chart reveals, after 4 years of negative real yields, bonds are once again providing investors with a rate of return that outpaces inflation. So bonds are obviously an important part of a diversified investment strategy. So that's why we follow rates and debt as closely as we do.
Yeah, and it's nice to see that information. So, a good balanced portfolio for our clients, depending on their ages, to see bonds working for them is fantastic. And with that, Trey, you interjected as we got into this conversation about bonds. You looked at the U.S. debt, which issues government bonds, and you elaborated on where we stand in terms of maturities in that U.S. debt. And I thought that chart was fascinating. Share that information with us.
Yeah. To Bobby's point, your point, there's two sides to every coin here. There's for every receiver of higher interest rates, there is a payer of higher interest rates.
True, very true.
And the federal government is the largest payer of interest in the world, as I think everyone's well aware of. And this chart here shows the net interest over time versus the 10-year Treasury. And the red line here is interest paid as a percent of government revenue. And the blue line is the 10-year Treasury yield. And I want to focus on the far right side of this chart. You can see that red line has spiked up to 14% of revenue is going out in interest payments. And that spike has happened in excess in the move higher in 10-year Treasury yields. Well, how is that? Why is that? The U.S. government debt is heavily weighted towards short-term debt. You can see on this next chart that the amount of U.S. sovereign debt outstanding, over 50% of it is in 3 years or shorter, and over 30% of it is less than a year. So as interest rates have been going up, that directly impacts the U.S. debt much quicker than the U.S. consumer. The U.S. consumer, over 90% of U.S. Mortgages is 30-year fixed rates. And so the U.S. consumer is locked in to long-term. The U.S. government is not. And so as interest rates are spiking, we're seeing that spike occur. And where this really hits, the rubber really hits the road, is that historically speaking, when debt servicing costs eclipse 14% of U.S. government revenues, that causes the government to have to tighten their belt a little bit and cut spending and find ways to reduce costs, because that leaves less money after interest is paid. That's the first dollar out. Interest paid is first dollar out. That leaves less money for everything else. And so really, you're probably going to start seeing a lot of talk of what's called austerity and some tightening of budgets in areas. And that may start tomorrow. The Biden administration, a not heavily covered part of the Inflation Reduction Act that passed over a year ago, was that there's a large healthcare component. And tomorrow, the Biden administration will announce 10 drugs where there will be price caps going forward on what the drug companies can charge. Now, the goal of that is to bring the cost of healthcare down. But again, there's the other side of the coin. Every dollar paid out for prescription drugs goes from somebody into a company. So the cost then is incurred by these companies. And that's not really been priced in. So we're about to see a political silly season. Even though these restrictions, price controls haven't even been announced yet, there are already 8 cases going through the works to challenge them. And so this is going to go into the political silly season and into the courts for the next few years. But it's something we're going to watch closely because it could have a negative impact of up to 8% a year in annual earnings on these companies, depending on which drugs are announced and what their prices are. But that's going to start tomorrow. Something big we're watching, but that's some of that belt tightening we'll likely see.
Yeah, no, and I thought the way you tied that in together was great. I mean, that's why we picked the topic, debt, drugs, and we're going to talk about driveways here in just a minute. Our clients constantly ask about their bond portfolios, that section of the portfolio that's comprised of bonds. Simultaneously, they talk to us about the U.S. debt and their concerns for that. And here's an example that can really impact some of our older clients who are now retired and looking at the cost of drugs. I think they need to be aware of this. So all great insight. And we also have people talking to us about their homes. Here at Five Plan Partners, everybody thinks we always talk about stocks and bonds. But when we do the financial planning, the value of that home is very important. And Ty, whether it's young clients looking to buy a house or older clients looking to transition and downsize, they're talking to us about interest rates and what's taking place. You had great data, and that's why we picked the word driveways, debt, drugs, and driveways. So elaborate on that.
A popular saying in our industry is housing punches above its weight for the economy. And, housing has really done a good job of holding up our economy while some other factors have kind of fallen back. And so we got July new home sales strong again. New single family home sales, this is the number of homes sold, increased 4.4%. If you go year over year, sales are up 31.5%. Which is, massive, obviously. Sales in July, specifically strong in the Midwest and the West. The median price of a new home sold was about $437,000. And I know that sounds like a ton, but with the increase in sales, prices are starting to come down. Prices are down, 8.7% from a year ago and over 12% from a peak of last year. And so, that's kind of the good news here. Supply is starting to catch up on the new home side. But, we still are facing some problems with the increase in rates. So assuming a 20% down payment with the rise in mortgage rates, from this year and last year, that's a 29% increase in the monthly payment that people are paying. That's, obviously massive. So if you're down 12%, but you're paying 29% more in monthly payments, you're still not coming out great right now. And so we need prices to further come down. And, I mentioned that supply on the new home side has been great. It's up 150% from the bottom of 2022, which obviously is huge. The supply on the existing home side, as you can imagine, is quite light because 90% of people are locked into a 30-year fixed rate mortgage, probably 3-4%, maybe even sub 3%. Not a lot of people are looking to move and start paying 7.5% on mortgage rates.
No, you're right. It is what it is, as the saying goes. And so we'll be watching all that information closely on all the topics we've talked about today. And I also want to say this to our viewers. I hope you found this information very valuable, and also that you share it with family and friends and colleagues and neighbors. Several of you have done that, and we greatly appreciate that because that's really expanded our viewership on our vlogs. I also want to tell you, and behind the scenes, while Bobby and Ty and Trey and I are doing these vlogs, Felicia Ludlam, who is our director of business integration, is there helping us organize all this, making sure things go out in a timely fashion. She oversees our social media as well. And so we've got a great lineup of information and topics we're going to be sharing with you in the coming months. It's hard to believe there's 4 months left to this year. And so we have got some great things to share and appreciate Felicia's efforts in organizing all that and coordinating with Brian Collins, who does our videos here at Five Plan Partners. So watch on LinkedIn, Twitter, Facebook, listen to our podcast, YouTube. There's a lot of work that goes into this, but we do it because we want our clients to have information that is valuable to them, that gives them knowledge to confront the fears and also know where their financial blueprint is in relation to the economy, the markets, and their portfolio. And we want every day you to understand that we go this extra mile and we do these kind of things because we want you, our clients, to have a better, richer, fuller life. And it's a team effort, and we are honored to be working with each and every one of you. Have a great week. We're getting ready to go into the Labor Day weekend. Relax, enjoy this week, and make some plans. And we'll look forward to talking to you next week. Thanks.